So I am now joined by Sebastian Lyon. So thank you very much for joining us.
Morning, James.
So I'm going to hand over to you and let you run through your presentation.
Very good.
And so you can tell us a bit about personal assets, please.
Okay. Well, thank you very much, James. Personal Assets is a trust that's obviously been around since 1984. Troy took over the mandate in 2009 as investment advisor, became manager in 2020. Personal Assets has always been about, certainly since 1991 when in Rushbrook ran it, it's always been about capital preservation, long-term capital growth. Income is a residual. And capital preservation is key, has always been key from the point of view of PAT, but also from the point of view of our multi-asset mandate at Troy. And this is all around, effectively, if you like, I think there was an IFA in Linlithgow called Alan Steele, who was described as his goalie, so his sort of last line of defence within his portfolio. You know, he had his strikers, which is his tech funds and emerging markets and aggressive high growth. Midfielders he describes as solid global growth equities, the big ugly centre back, which would be probably UK income, something along those lines, and then finally multi-asset in defence. And why is that? Well, effectively, as you can see from the right-hand side of this slide, if you lose 50% of your money, you have to get 100% to get back to square one. We've had three instances in the last 20 odd years where markets have fallen more than 4%. So this is about effectively for those investors in particular who are probably older, but in particular have made their money and don't want to lose it, then this portfolio, personal assets and multi-asset at Troy, is a good place to be. And that's how we've run money for going back 23 years. And the man on your left is Peter Shilton, who is the England goalkeeper in the 1980s, and who, in particular, he had the cleanest sheet of the of all England goalkeepers. So that is effectively what we're aspiring to do from an asset management point of view. James, if you go to the next slide, you can see the track record. This is the pre-PAT and post-PAT. So during the long bear market of 2001 to 2003, 2006, 2009, the financial crisis, and 2019 to 20 in terms of the COVID pandemic. Some of these bear markets were sort of partly predictable. COVID most definitely was not predictable. Obviously, it came from clear blue sky, came from left field. And yet in all three of these instances, as you can see, the maximum drawdown of the equity market was between 46 and 35%. We protected and recovered quickly as well. If you turn to the next slide, you'll see that recovery. And it's all about getting back to square one. So in those three cases, we got back to square one in terms of we made up the losses that were incurred during those very difficult periods in a question of 2 or 3 months, whereas for the market, you're talking about 15 to 28 months of being underwater. So I think what this demonstrates is that we've given people a far more comfortable ride that they would have had within the equity market, which is really what we're all about from the point of view of personal assets. If you turn to the next slide, you can actually see that not only do we protect, but also we up our risk during periods of very material drawdowns. So whether it be in the bear market of 2001 to 2003 on the left, where we were gradually increasing equities consistently, and the blue line is our equity allocation, just to be clear, the red line is the market. In the financial crisis, actually, you can see very clearly that we actually reduced our equity exposure going into the financial crisis, ahead of the financial crisis, and then at the teeth of the financial crisis in late 2008, we actually increased our equity exposure very materially by sort of 20-25%. And then on the right-hand side, we see COVID, which, as I said, was incredibly quick. You had to react very quickly. We did increase into those falls very materially. our equity allocation as well by sort of 10%. But it was all over so quickly that we would ideally would have liked to increase it more, but the turn was very quick. But at least we did. I think the key thing is it's more about the modus operandi in terms of the fact that when we're paid to take risk, when valuations fall, and actually the risk return improves, then actually we step in. So we don't look at it from the point of view we take stop losses. On the contrary, we actually lean in, take more risk when we're paid to take more risk. So we differ from others from that perspective. So that's that slide. So moving on to the asset allocation and how we have generated our returns. So over the very long term, we generated our returns predominantly from equities, almost 2/3. Even though over the life of the mandate, we probably had about between 40 and 50% in equities. So we had 3 times the amount of returns from equities other than anything else. And very importantly, and I think this is again a differentiator for Troy, and particularly as a multi-asset mandate, we are very much focused on equities first. Equities drive the returns over the long term, and careful, sort of very carefully thought through stock selection over the long term is how we generate these returns. I tend to be a believer in terms of actually adding equity value. Equities become good value either when they're very distressed, but that can be very high risk. But it can also be when investors are actually just very bored with that particular industry or that particular company. There's just a general lack of interest, and we found the best opportunities from this mandate's perspective is when people are disinterested. Then that is an opportunity to buy into stocks that have underperformed and offer good prospective returns, because that sentiment can ultimately change, and also the reasons for that sentiment being negative can also change as well. We are long-term investors, so while some of these holdings are actually relatively new, one being VeriSign and the other being Chubb, which we bought this year, Unilever we've held for 20 years, Microsoft we've held for 15 years, Nestle we've held for 15 years or 14 years. So we actually hold these stocks for quite a long period of time. We know them well, and there's also a lot of overlap between what we hold within the equity part of the portfolio for personal assets and what we hold in our global income, global equity, and UK income mandates. There's a lot of toing and froing between each part of the Troy's equity mandates, between the multi-asset team, between Charlotte and myself, and the rest of the team as well. And then thereafter comes the other assets, fixed income, gold, and cash and currency, which have all contributed positively to the long-term returns. So we move on to the next slide. We can see that this is why we are cautious just at the moment. The valuations are high. They are pretty much where they were, not quite as excessive as they were during COVID, during that profitless tech period, where we saw huge speculation, probably the greatest speculation that we've seen since the dot-com boom, 24 years ago. And you can see actually this chart doesn't quite go back to the dot-com boom, but it goes back to the sort of the bust which I was referring to earlier, 2002 to 2003. But it was a very, very expensive and highly speculative market in 2022. But valuations from here, we feel, are not quite an extreme, but are very high. And we feel that prospective returns are low. And we would certainly agree with, along the lines of Goldman Sachs, which came out recently, that said the US stock market from current valuations would generate a relatively low single-digit return from here over the next decade, compared to where we were a decade ago or more in 2009, when valuations were obviously very depressed and prospective returns were very good. We're also not entirely surprised to see Warren Buffett selling down. He's always used market cap to GDP as a rule of thumb. Just we haven't got that here, but the market cap to GDP in the US in 2009 was 60%. Today it's 200%. So, which is pretty much the highest it's ever been. So we think that it is wise to be a little bit more prudent and to be erring on the side of caution, and that's the reason why our equity allocation is relatively low by long-term standards. So moving on over to the rest of the portfolio. On the next slide, what else do we hold? Well, we hold index linked, and actually index linked and tips in particular have been actually a good way of grinding out positive returns over the last 5 years, and actually you can see the difference between the nominal yields in red and the inflation protected yields in blue, or the returns on those assets have been very materially different. Why is that? Well, basically during 2021, 22 and 23, when inflation spiked, we got that inflation buying the inflation linked bonds. However, we do feel that we're in a very different era from the one prior to the 2020s, the 2010s, which was the end of the era of ever falling yields. And we think we're more in an era where inflation protection is more important, and particularly where fixed income with duration is really not the place to be. So from a multi-asset perspective, we think that that US tips, certainly with a reasonably short duration, is a sensible place to be. At the moment, they're yielding 2% real yields, so you're getting 2% plus whatever the inflation rate is. We think that inflation rate over the next decade is likely to be higher than the last decade for reasons perhaps I'll come on to talk about later on in the presentation. So moving on to the next slide, and just talking for a minute about the context of multi-asset. Multi-asset is all about protecting the real value. We're not so much interested in outperforming the stock market over short and medium term periods, albeit that we have over the long term outperformed stocks. Effectively, the primary enemy is inflation. And as you can see here, since we launched our multi-asset mandate back in 2001, on the left-hand side, you can see the devaluation of sterling in real terms. So this is effectively sterling adjusted for inflation, has now fallen a fairly spectacular 55% in real terms over those 23 years. So that is the enemy. That's what ultimately we've got to offset for our investors. What we want them to do is to come back to their investment in 5, 10, 15 years time, whatever it might be, and at least that we've done the job of protecting the real value. And the reason for the picture of Harold Wilson, which some may or may not remember, I think I was in shorts when Harold Wilson was Prime Minister, but he very famously talked about the devaluation of sterling in November 1967, saying that effectively it didn't affect the pound in your pocket in the UK, even though overseas, obviously, it was a devaluation from $2.80 to $2.40. But the fact of the matter is that, of course, that was a very disingenuous statement, and it was very much a devaluation of sterling in the UK as well, because anything that was imported was cost you that 14% more than it had done the day before. So devaluation is nothing new. It's the enemy of investors, and it's the enemy of savers, and it's something that actually, from a personal assets point of view and a multi-asset point of view, at Troy, we're very aware of. Moving to the next slide, and this is moving us on to gold. Gold we've held for a long time at Troy. It's effectively diversified within the portfolio. You might say that it's in lieu of portfolio protection, which is much more expensive than using derivatives. We're often criticized for holding gold. We're often asked, how can you hold gold? You can't value it. But actually, there are lots of assets which yield nothing that actually rise in value over the years. And actually, gold has the longest track record. It's got a 6,000-year track record in terms of preserving capital. If you recall, 100 years ago, our currency never devalued because actually it was denominated in gold rather than in paper money, which we obviously came off the gold standard in 1930. But prior to that, we never had these devaluations and that inflation, which I mentioned before. But there are plenty of assets, whether it be the Botticelli top left or Stradivari violins or whatever it might be, Hockneys, they appreciate in value over a period of time. NFTs, ironically, crypto art, top right, really hasn't appreciated In fact, it's fallen by 90% since 2020, since that effectively 2021, since that COVID bubble, post-COVID bubble. And sometimes these things don't always work out. Brand furniture has been terrible. We're often asked about Bitcoin. Bitcoin, we feel, is just too volatile. Clearly, it's been very good in the last 2 weeks since the presidential election. But in the last decade, you've had, I think, 3 or possibly 4 drawdowns between 70 and 80%, which just make it not appropriate for this mandate. Apart from anything else, the FCA wouldn't allow us to invest in it, quite rightly, in my opinion, even if we could. Moving to the next slide, and this has got the gold price. Clearly, until very recently, until maybe 10 days ago, it was making all-time highs. It's down a little bit from the peak, albeit that's been a function of stronger dollar. So if you've seen the sterling price has not fallen nearly as much as the dollar price, and we don't hedge our gold back into sterling. So effectively, it's the sterling price that really matters to us rather than the dollar price. But as people are so familiar with the dollar price, I thought I would highlight it here. Just to say that we've held gold as part of the portfolio diversification going right the way back to February 2005. It's done a very good job for us. It's compounded since that date at 12% per annum. Effectively, that compares to the S&P 500, which has only performed very marginally better, 12.7% per annum, and has by far and away outperformed the UK stock market. The FTSE 100 is up 6.4% per annum over that same period. So it's risen from $424 to $2,560 today. We don't hold gold miners at the moment. We have done in the past. We'll never say never, but we find there's a very good reason why miners have underperformed gold. They're very capital-heavy businesses. They're very highly cyclical. And frankly, the cash tends not to end up in the shareholders' hands ultimately. And so there is a notorious track record of gold miners of investing, frankly, in allocated capital pretty poorly. And over the long term, you can actually see that. We have actually in the past owned a gold streaming and royalty business, Franco-Nevada, which we sold about this time last year. And the reasons for that were very stock specific rather than anything to do with our dislike for gold. We've got a quote here from the Wall Street Journal. Let's be honest about gold; it's a pet rock. Frankly, we couldn't disagree more. I mean, unfortunately, our newspapers and financial record, the FT and Wall Street Journal, for some reason, don't really understand gold. But actually, central banks are certainly investors that do understand gold and believe in it and have been adding to it. I mean, the interesting thing about the gold price over the last 3 years since the invasion of Ukraine, or 2 years since February 2022, is that central banks have been buying. I think predominantly due to de-dollarization, effectively due to the sanctions that were put on Russia. Effectively, other countries, either non-neutral countries or neutral countries, have decided to increase their reserves. Countries like Singapore, the Czech Republic, Poland, but also in particular China and India as well. So they have been offsetting selling, which has been coming from the West, in terms of increasing their reserves on their central bank balance sheets. So we've been to some extent a beneficiary of that. I would just add that we have actually reduced our gold holding this year into that strength. So we sold some in March at about 2,400, and we sold some in September, October time at about 2,700. So we've been reducing the holding into that strength, but it's still around between 12 and 13% of the portfolio today. And the key thing is that you need enough to make a difference. There's no point in holding 1 or 2%. You've got to hold, call it 10% plus or minus, and that's where we are today. Moving to the next slide, this is just effectively our concerns over geopolitics. And I think that one of the things that's particularly concerning about geopolitics is I think the world has changed. I think that's very clear. In a post-COVID world, we're looking at a world where all of those trends have been in place for 40 years that have been disinflationary, but really began right the way back in the 1980s, are now, with Reagan and Thatcher, are now reversing. We saw the Berlin Wall fall down, which opened up labour markets. We saw China joining the WTO in 2001. All of these factors built up to have a very pro-disinflationary period. But since COVID, you've seen fiscal stimulus being very aggressive. You've seen money printing. You've seen hot wars in Ukraine, in the Middle East, and you're now seeing the election of Donald Trump, who's advocating very aggressively the introduction of tariffs up to 60% on Chinese goods. Those will be inflationary, and they are certainly not pro-growth. They're certainly not pro-growth globally. So we think that we're in a new world where yields are likely to rise, and where inflation is likelier to be sticky, if anything, or certainly volatile, not likely to be as subdued that it has been in the past. And this is a new investment environment compared to the one that we were in, frankly, in the 2010s. So what's next for us? Moving to the next slide. The fact of the matter is, and I think we'll be perfectly open, and I think it's very important, we don't know. And I think that we start off from the point of view that we don't know. We don't know whether there'll be a soft landing, a hard landing, a no landing. We do think that a soft landing is basically discounted now. So if a soft landing doesn't occur, then people are going to be surprised, perhaps either to the upside or the downside. If there's a no landing, if the US economy continues to sail on, then I think there is a real risk of things getting too hot and inflation coming back. If there is a hard landing, which should not be ruled out, certainly a lot of the economic indicators are deteriorating in the US, then clearly that will change the profitability for businesses, and we'll see an effect on the stock market that way. But within this fund, within this mandate, within personal assets, we're always trying to position the portfolio for not one single outcome. So effectively, we are had to remain open to all potential outcomes, bearing in mind effectively what's available in terms of the menu, in terms of prospective returns today. So moving to the next slide and just finishing off, really, this is where we are positioned today for multi-asset portfolio for personal assets. We're about just under 30% in equities, which is the lower end of the range. That doesn't mean that there isn't activity going on within the equity part of the portfolio, and we would like that part of the portfolio, frankly, to be higher. But just for the reasons that I gave earlier, we think that's about right. Index linked is 37%, gold 13%, and the balance, which is liquidity, effectively short-dated government bonds, of the 21% and only 1% in cash. The really big change, I suppose, over the last 3 years is that we can now get a yield on our cash, which we couldn't before, which has been very helpful. The next slide just shows the long-term track record. Oh, sorry, beg your pardon. The next slide just reminds you of the DCM, the discount control mechanism for PAT, which is which has been unique in terms of over the very long term. So we've had effectively a DCM in place since 1999. It's enshrined in the article, so we can't do anything other than do it. You will see from where the AIC flexible investment sector is, the discounts have widened out very dramatically to over 20% in the last few years. Very painful in terms of those discounts widening. PAT shareholders have been protected from that. So whatever happens to the NAV, at least we can guarantee that shareholders can both buy and sell relatively close to the NAV. So they don't have the double whammy of the falling asset value and the widening of the discount. And obviously, this helps the NAV as well because it's enhancing as we buy and sell back. That's enhancing for the NAV. But it removes all discount volatility, which is unique to PAT. But particularly in light of what I was saying about our investors being conservative investors wanting to protect the downside, this obviously protects them from that in terms of having the share price negativity in particular. And with that, I think, James, that's my last slide. Oh, we've got the performance there as well. Yeah. So that's the long-term performance. You can see, unfortunately, the inflation lines and the banking lines aren't there, but you can see that the longer-term returns of the trust. And the one thing that I would highlight here is that you can see that almost every strong year in the equity market we have lagged, almost particularly during recoveries, but almost every year where there's been a fall, we have outperformed. And then obviously There have been years where we've outperformed rising markets, falling markets. They can be in the modest years, but generally speaking, but in particular, we've got a very good track record of protecting on the downside. So, James, with that, happy to answer questions.
Great, thank you very much indeed, Sebastian. Let's think about the asset allocation here for a minute. So, you said you've been taking profits from gold. So there's a question early on, would you expand it actually? But so what sort of determines what the right level is for something like that?
Yeah, it's a great question, and I think it's very important to identify that it's an art and not a science. And I think one needs to look at sentiment. One needs to look, we're on top of the gold market. We know what's going on. We speak to people like the World Gold Council. We speak to others who invest in gold. We recognize that sentiment can run ahead of itself, and we also look at it from the point of view of, importantly, sort of where its role is within the portfolio, how much it needs to do, how much heavy lifting it needs to do. We think that many people got gold wrong in the last 2 or 3 years. They saw interest rates rising, and they also saw real interest rates rising. And they thought that would be a very material headwind for gold. But I think that, as I said, we're in a new environment, probably more like the 60s and 70s, frankly, which was a very good period for gold, because the world is hugely in debt, as we know. It's struggling to grow. We need to inflate our way out of that debt. Politicians and central bankers and others are not going to say they're going to inflate their way out of debt, but effectively that is the only way to do it. And so gold will have a key role to play, and there is also a geopolitical role to play within the portfolio as well. But I think that we've learned the lesson from the past, whereby we don't get more excited about it the higher it goes. So we have a band of between sort of 8 and 13%. When it goes over 13, we trim it back down. So as I said, I think in the presentation, if we'd done nothing this year, it would be 16%. So we've probably taken 2 or 3% of our profits effectively out, and get less enthusiastic about it the higher it goes, rather than more enthusiastic. We don't have particularly a target price. We don't think that's necessarily the way to think about it. We don't actually have target prices for stocks either. So I've always felt that investment is as much an art as a science. But we do think that it's a good portfolio diversifier. It's done a really good job for us in times when things get really difficult, like the invasion of Ukraine, like during COVID, like during the Gaza situation, when geopolitical risk picks up, and I think we are in, frankly, a world of heightened geopolitical risk, then gold will be a good place to be, or a good place to have part of the portfolio. And it costs us, frankly, a few basis points a year, compared to if we were running a long short fund, or running a fund where we wanted to protect on the downside and had to pay very expensive derivatives, which can actually be very illiquid and not necessarily as marketable. The good thing about gold is it's extremely liquid. We could sell all our holding in a day. It really wouldn't be difficult. So from that point of view, it's attractive, and it's doing something very different. And we do think we're not. We can come on to this, but we're not in a world where long dated fixed income is the place to be.
I think you've just answered a question that I had, which is why not buy some sort of derivative or something as insurance if you think the world might be more volatile?
Well, James, I mean, I'm sure that investment banks like Goldman Sachs, Morgan Stanley would be falling over themselves to talk to me if I suddenly said I wanted to, buy puts or sell calls or whatever. We've never done that. We've always, and I think personally, I would say this, but I think it's a virtue of the way that we run money, is that we're long only. We're not long short. I've seen sadly many come a cropper in shorting stocks. I've seen many come a cropper in terms of shorting the market. I think it needs a totally different mentality, really. I think the way that we structure the multi-asset portfolio, which now we've been doing for 23 years, is we are considering the downside, but the way that we invest in stocks, the types of stocks that we're investing in. I mean, I think COVID, in a way, for personal assets was a really good tire kicking moment, because it immediately came out of the blue, because it was so immediate. You couldn't, unlike the financial crisis, which sort of came in stages, and you couldn't, of course, you didn't know that Lehman was going to go bust, but you could see there was some real problems building up in the system over a period of, I mean, years, not months. I mean, Northern Rock went bust in August 2007. A year and a month before Lehman. So there were straws in the wind. There were signs there that you needed to rein back your risk, get out of banks, etc., and things like that, and make your portfolio more defensive. In the case of COVID, I mean, it all happened in a month, really, from January to the middle of February. Really, that was sort of building up, but really it was from the middle of February to the middle of March. Sorry, it was end of January to the middle to the end of March. Less than, I think it was 9 weeks from peak to trough. You had no time to react at all. Markets reacted incredibly quickly. So basically what I'm saying is you needed the defensive portfolio in place before that happened. You couldn't move. And actually our portfolio was down less than 10% during that really horrible stomach lurching period, which was unbelievably quick. So I think that we were tested in that period, and our equities were tested in that period as being sort of survivors rather than companies which were going to struggle in a period where where effectively the economy almost shut down, for want of a better description. And obviously we couldn't travel, and for us, not being in things like airlines, not being in banks, not being in highly cyclical businesses was a huge help to protecting capital during that period.
And then I think you also dealt with, but maybe we can expand it slightly, that why not hold longer dated bonds?
Yeah. I mean, I think that, James, what happened during COVID was critical. I know it's going back 3 or 4 years, but I think it's absolutely critical to the change of the environment. We didn't have it on this particular presentation, but if you look at the 10-year Treasury, it was in a downward falling yield for 40 years. So from when Volcker put up rates very aggressively to 20% in 1980, I think it was, or maybe even 1981, that called the end of the bond bear market, which had been going on for about 20 years through the 60s and the 70s, and even through the late 50s as well. Yields have been rising and rising and rising all the way through that period. And then since 1981, yields peaked at about, I think it was about 14 or 15% on the 10-year Treasury, and it's been falling ever since, thanks to what I mentioned about the geopolitics, the whole Reagan, Thatcher, the opening up of the economy, market economies being allowed, the whole liberalization of financialization of markets, but also free trade, the WTO. All of these things really helped the disinflationary forces, which led to that ever grinding lower. The one thing that I remember going back to 2019, 2018, is that it was really felt that after the financial crisis, central banks were seen as if you remember, the rock stars of the financial world. The focus of policy wasn't on the Treasury officials and the Chancellor of the Exchequer, it was on actually the Bank of England. And I remember Mark Carney and Christine Lagarde saying in I think it was 2019 or 2018, the next crisis that happens, we won't be able to do everything. We need governments to help us do that. And whether it be a recession, whatever it was, a hard landing, that was clearly the policy shift that was occurring back then. And I thought that was a really key change, almost a once in 40-year change of the change in cycles. And since July, August of 2020, when yields troughed at 0.5% on the 10-year, we have been in basically a rising yield environment ever since. So for the last, whatever that is, 4 years, yields have been grinding higher. We had that period of inflation, yields shot up to sort of 5%. They then went down to 4, but they're now up to 4.5 since Trump won the rally. And I think we just are in a period of rising rates. And the one thing, James, you don't want to be in a period of rising rates is long duration. There's long duration assets, particularly long duration bonds. And so we are very cautious. We accept that from time to time there will be a trade. There was a trade a year ago. You could have bought treasuries at at 5% and watched the yield go down to 4 and sold them. But it's a trade. It's not a long-term strategic view. The long-term strategic view is that bonds are basically in a bear market. If we had a hard landing, we'll see yields go down again. But I suspect that interest rates won't go down to 0 again. And I think we are in a world of rising yields. So we want to be really careful to manage yield and manage duration. And if we do want duration, we want duration in our equities rather than bonds. So don't forget, I mean, equities are a duration asset as well, but at least they have real growth. So we definitely want more equities than we do long dated bonds. So I would be very careful of taking that duration risk, and in preference taking the duration risk in equities rather than in fixed income.
Makes sense.
And
Thank you.
That's a new world that we're in.
Yeah. Let me go back. There we go.
Yeah.
Thinking about the stocks that you hold, what makes an interesting stock company for you?
So I think that what we're looking for is we're looking for consistency, stability. We're looking for strong balance sheets. One of the things I always say is what we want to do, what I always was trying to do, even going right the way back to 2001 when we launched the multi-asset mandate, but also from perhaps from 2009, is that we wanted companies that were complementary, but importantly, didn't have very material drawdowns. Weren't companies where you would suffer permanent capital loss. And I think my experience of managing equity portfolios throughout the 90s, and owning and being effectively an index-driven, index benchmarked investor, which is very different from the way that we invest for multi-asset. We're not looking at indices at all. So frankly, we're very happy to leave a vast bulk of the index behind. We haven't held a retail bank for 25 years, 24 years. We don't own things like house builders. Obviously, they've had a very difficult time over the last 18 months or so. These businesses that are highly asset intensive, highly cyclical, you can lose a lot of them. You can lose 80-90%. I mean, I was blooded by the stock market when I first started back in the late 80s, early 90s by that recession. House builders fell in value by 90%, and they were raising incremental capital. We want capital light businesses that aren't going to be knocking on our door asking us for more money when the shares are very depressed. I mean, airlines did that as a very good example during COVID. So if you remember I was saying British Airways, that shows my age. IAG, not only did the share price fall 70% during COVID, but they actually raised 3 billion euros right at the bottom. So they asked their shareholders for more money at the bottom, the shareholders having suffered a 70% drawdown. That's exactly what we're not doing. So if we forget all of that and push that to one side, and we're really focusing on the businesses that are resilient and sustainable, and hopefully have repeat and recurring revenue, so that the management of these businesses can actually manage the businesses thinking about 5 years, 10 years forward, and preferably having management who are not gunslingers, who aren't guns for hire, but who are interested in generating the long-term value for the business, and also ultimately, when their time comes, handing over the business in a much better position than they inherited it. I mean, two of our most recent transactions this year. So we sold 2 businesses and bought 2 businesses. I mentioned Franco-Nevada in our presentation, and that was very much a stock-specific issue of they had one mine that they had a stream from, one of the largest mines in the world in Panama. There were clearly geopolitical reasons. There were political issues in Panama. That mine was closed. Fortunately, we sold it before the mine was closed. We saw what was happening there. It was actually a really good stock for us. We doubled our money over 5 years, 5 or 6 years from 2017. But we realized things were changing, and when things change, we act. We don't believe in buying forever. We believe in low turnover, but we don't believe in no turnover. And actually, considering what the gold price has done in the last year, the shares are actually down from where we sold them a year ago. So it was absolutely the right thing to do. But we also sold back to Dickinson. Similarly, we didn't lose money there, made a bit of money, but that's the world's largest syringe manufacturer. And we just felt it wasn't really executing in the post-COVID world, which it should have been, because as operations came back, hospitals opened up, there were more procedures going on. It should have done better than it did. So we have patience, but only so much. The two ads that we've had, I think, actually tell you an interesting story about our equity selection. So with VeriSign, that effectively is the internet, effectively it owns the .com domain and it owns the .net domain. So the .com domain is the largest in the world by far. The .net domain is, I think, the fourth largest in the world. And effectively, you have to, if you're using a .com or a .net domain name, you pay VeriSign. You may not know it because you might do it through a third party, but you pay VeriSign $10 a year. Very small amount. And it's a great compounder. It's very asset light, very high margin. It got hugely overblown during COVID. It got 40 times earnings. We were watching it, and then we bought some in the middle of this year at about 20 times earnings at 5% plus free cash flow yields. So it shows a sort of patience. People were obviously bored of it, disappointed with it. The execution of the business continued to be very good. But that was one which we added. Chubb, also the world's largest property casualty insurer, we bought this year. PE of 11 times, not particularly love stock, but really they execute incredibly well. So that is very well managed. It's a very high margin insurer. They tend to go where the returns are, so they're very happy to switch on and off the tap. But also a good diversifier for us in the fact that insurance has a different cycle to other parts of the stock market. So often insurance does quite well when stocks aren't necessarily doing well. So we're thinking about it from the point of view of portfolio construction as well.
That's great, thank you. One last question, I think, from me. How do you sort of approach your dividend of the trust?
Yeah, so the dividend has been, or the income from the trust has been increasing. I mentioned earlier that we really don't run the trust for income. And I think that's very important. This is a capital preservation vehicle and a capital growth vehicle. Income is residual. I think if you start running a portfolio where you're only focusing, or you're trying to do all three things, you're trying to protect capital, grow capital, and generate an income, I think you start getting into some trouble. And I've seen this before, you start reaching for yield for the dividend. And I think reaching for yield is the worst possible thing. And we've seen many traps out there, particularly in alternatives like renewables and that sort of area, infrastructure, where people have reached for yield and yields have risen and the capital value has fallen. And so we're very aware of that. But in terms of the dividend, I think the yields on the portfolio is about 2%. We've paid, the last 2 years, we paid a special dividend. So we paid a flat dividend for the last sort of 8-9 years. The last 2 years we paid a special, and I know the board are reviewing the idea of increasing the ordinary. So watch the space, but I can't say more than that at the moment. But it would be nice to get into a situation whereby we're starting to increase the dividend without using specials. But the yield on the portfolio is, the yield on the trust is about 1.5, between 1.5 and 2%.
Thank you very much for that.
Moving back to a period of growth.
Yeah. Thank you very much for that. We've covered a lot of ground, and thank you for sort of bearing with us with the technology as well. So we will follow you up again and talk to you again in a year or so, hopefully. But thank you very much for today.
No, pleasure, James. Very nice to see you. Thank you. I'm glad we managed to get there in the end.
Cool.
Good stuff.
Great, thank you. So we will be back next week talking to Alex Crook from Bankers, and the week after is our next quarterly panel. We're talking about investing for income. I'll tell you a bit more about next week. And then we've got shows on the 6th and the 13th of December. Then we've got a break for Christmas, and then on the 3rd of January, Andrew and I will be back talking about what happened over the course of 2024. So thank you very much for tuning today. Apologies for the technical problems, and we will see you again next week. But in the meantime, if you haven't voted, do vote, please. We are coming up to the end of this, and 17th of November is the final day for voting in our awards. Thank you.